Everyone to Daily Rates Live with the Mortgage Calculator. We'll get started here in just a moment. We have the chat up on the screen. Feel free to drop a comment there as you tune in. I see Maria and Owen already dropping comments there. Appreciate it. We will start in just a few minutes. Let us go live on all the different platforms. We are streaming this on YouTube, Facebook, and LinkedIn. So just give us a moment here to go live on all the different platforms and give everybody a chance to tune in as well. Again, go ahead and drop your comments in there as you tune in. We appreciate the comments. Thank you, Victoria, for the comment. Good morning. Good morning to everybody tuning in. And we'll get started here in just a moment. Hope everyone had a great holiday weekend. And we are back to the grind. Jason, thank you for the comment from LinkedIn. Appreciate that. Michael, thank you for the comment. All right, it looks like we are live on all the different platforms, so we can go ahead and get started. As we go through here, feel free to keep dropping comments there. We appreciate it. And feel free to drop some questions as we go through the deep dive as well. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do on the show every morning is go through some actual live rates for different programs, and then we do a deep dive into a different topic. Now, today's deep dive is going to be HELOC loans, home equity lines of credit. So our sales manager, Jose Gonzalez, with 28 years of experience, is going to do a deep dive into HELOC loans and give us some examples. But before we do that, let's pull up some live rates and see what they look like. So Nick, let's go ahead and pull up our pricing tool and see what the market is doing this morning.
All right, switch my screens and check it out. This is our pricing tool for our mortgage professionals. This will show us the general rates and APR with all the fees. For today, it is September 5th, just after 11 a.m. Eastern. So after holiday weekend, we have some live rates for all our standard programs. If you'd like a full breakdown of all of the fees that go into the APR, a full loan estimate, please get with one of our team members. We have over 300 licensed loan officers in 24 states. And we can do our business purpose loans in 44 states total. So for today, as we do every day, we'll set up a basic scenario so we can compare across the programs. We'll set up a $400,000 loan amount. We'll set the LTV to 80% loan to value, 20% down payment. We'll set the desired price to $99. That means we're going to ask the computer to find the best rate at one discount point in cost. And we're going to check out our conforming conventional options, compare that with FHA, which is usually the next best option. And then we'll go into our expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs beyond the standard options here. We also offer VA and USDA. VA is only for our eligible vets and active service members. If you are eligible, let us know. We can quote it, no problem. And USDA is only for properties that are eligible. If your property is eligible, if you're looking in one of those areas, please let us know. We'd be happy to quote it. But since not everybody is VA or USDA eligible, we do not do that live. So we'll start with conforming conventional. We'll do a purchase, 30-year fixed, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated FICO of 760 and an estimated debt to income ratio of 40%. So with these settings, let's see what the rates are after the holiday weekend. Looks like it's up just a touch from what it was last week, 7.25, 0.875 discount points and cost. That's our final APR, 7.413. So it's still lower than it was there at the peak last week and the week before. But hopefully we see some more downward momentum here after the market stabilize. Now, if our customer doesn't qualify for conventional for any reason, usually the next option that we compare is an FHA option. FHA does allow a little more leniency on credit events and allows a much higher debt to income ratio typically. So That is usually why we will use it, but we'll keep everything else exactly the same so we can compare APR across the programs. So for FHA this morning, it's up just a touch. I think last week it was just a touch below 7. Now we're a touch above. So 6.5 rate, 0.875 discount points and cost puts our final APR just a touch above 7 at 7.088. So still a good option here for our customer that may qualify for both FHA and conventional. FHA is actually a touch cheaper, even including the mortgage insurance, the upfront, and the yearly mortgage insurance that is required. So definitely check out FHA, especially with the markets being a little crazy. A little bit of savings there doesn't hurt anybody. And our customers that must use FHA for the credit or the DTI issues that may come up, definitely a pleasant surprise. Now, where we love to specialize, if our customer doesn't qualify for either program, typically most banks or lenders don't have any other options, but that's where we love to guide our clients through our expanded guidelines, also known as non-QM. We have over 5,000 additional loan programs beyond the standard conventional FHA or other options. So we'll keep everything else exactly the same as the scenario. However, when we choose non-QM, we can choose an alternative income. So full doc is what we use for FHA and conventional. So if our customer doesn't qualify for those programs, we're going to likely choose an alternative, such as asset related, business bank statement. Our investor programs are just for investment properties. We'll talk about that in a minute. Personal bank statement, 12-month is the most popular program by far. That's the one we use for our demo. We also have RSU, stated income, VOE, 1099, P&L, and no income CDFI options. For the demo, though, we always use the 12-month personal bank statement, which is our most popular option by far, and that's for our self-employed borrowers. Many times our self-employed borrowers are the ones that struggle to qualify under the conventional terms with 2 years of tax returns for various write-offs or other reasons. So therefore, we can solve their problem here using just their bank statements, no tax returns involved at all, just their last 12 bank statements to determine a debt-to-income ratio of 40% in this example, using just their cash in the bank, no tax returns involved at all. So most of our self-employed borrowers will qualify for double or triple the income and can therefore qualify where they would not before. So let's check out our non-QM bank statement options today. So best option at the top here, 7.5 rate, a little more cost here, 1.875 discount points and cost. The non-QM programs do cost a little bit more, but that puts our final APR at 7.596, which is just a touch above conventional. So last week we were beating conventional with non-QM in a couple cases, but today we're just a touch higher, which is more typical. And if you scroll down here, you see we have tons of different options, hundreds of different options here of bank statement programs. Some of these different programs may allow credit events, foreclosures, bankruptcies, things like that, and allow us to qualify where we would otherwise not qualify for a conventional program. So not only can we fix the income issue, but we can fix other issues as well with these non-QM programs. So tons of different options. Please get with our team. They'll find which one works best for you. Now, we always do our live pricing for investment properties. So we want to do a couple different options here for investment properties. We'll set up the same exact scenario, ADLTV, 20% down payment. And we'll compare our two options for investment properties. We have our conforming conventional, and we have our non-QM expanded guidelines options. Remember, the government programs, FHA, VA, USDA, do not work for investments. So we'll start with conforming conventional. Everything else will stay exactly the same as all our other demos. The only thing we've changed here is the occupancy to investment property. So let's check out the investment property rates this morning. The best option here at the top, 7.625 rate, 3.5 discount points and cost, pretty hefty cost there, puts our final APR at 7.875. So a good option for our customers that want to qualify for a conventional option. Very spendy though. Most of our investors that look at this option would rather choose a higher rate in order to reduce this cost. 3.5 discount points and cost is $14,000 in this example. That's a lot of money that our investors would usually like to spend elsewhere. So typically our investors ask to look at another option, which is our non-QM options. So we'll set up the same scenario, ADLTV, investment property, and this time we'll choose expanded guidelines, also known as non-QM. And we'll have a couple different options pop up. So first we must select our income as we did before, and the most popular option for investment properties is going to be our DSCR option. And that's because it doesn't require any income or employment from our borrower. We simply use the estimated rental income to determine a DSCR, debt service coverage ratio. If the estimated rents can cover the PITIA of the mortgage, the expense of this loan in this case, that's a ratio of 1.00 or higher, aka the property cash flows monthly. We also have options for ratios under 1.00 where the property does not quite cash flow on a monthly basis. So tons of different options here. We always put 1.5 as the highest value so we can see all the programs pop up. And the final thing we must select is a prepayment penalty. 3 years is standard for these non-QM investment properties. We can choose 0, that will limit the loan programs that show up and cost more. We can also choose 5, that will limit the loan programs that show up and save our customer a little bit of money. So in order to show all the different options, 3 years is the most common. So that's what we do for our demo. So let's check out the DSCR options this morning. Ooh, still beating conventional by just a hair. Amazing. Best DSCR option here at the top, 7.75 rate. So a touch higher on the rate, but look at the discount points now, 0.975, more reasonable option. And that puts our final APR at 7.816, just a touch under conventional. Absolutely amazing. Every investor on the planet would take a DSCR loan over a conventional loan when the APR is lower. It's an absolute no-brainer. But we do have some other options if our customer maybe has some credit issues, bankruptcies, foreclosures. We may need to use some of these options at a little bit higher rates of cost. Some of these other options here may also allow us to use short-term rental income, which is a very common request. So obviously the best options for properties that are cash flowing, we have some great options that beat conventional, and then 100 different options that may allow a little bit of more flexibility if needed. So please get with our team. They will find the best DSCR or non-QM options for you. Now let me switch my screen and we'll get into Jose's topic for today. So today we're going to be talking about HELOCs, home equity line of credit. So this is a specific type of typically second mortgage type of position that's obviously the more traditional type. So we have a couple other episodes later this week that are going to go over the alternative options for this, our fixed rate second mortgages and our investor second mortgages and all the cool options that we have. But today, Jose is going to go over some HELOC options, which is more traditional and more geared for our primary borrowers. So Jose, if you want to talk a little bit about the options you have pulled up, let's go ahead and have you take over.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Great to be with you this morning. We have great HELOC options and we have great HELoan options as well. So I wanted to differentiate between the two. The HELoan is a fixed second mortgage. It is a closed-end second, right? The HELOC is an open-end second. It is a variable rate. The HELOC is the one that gives us a little bit more flexibility when we're combining it with a combo loan, like to get around having to go with 25% down when we're looking at a limited review condo. The HELoan does give us lower rates since they are fixed rate, and it does allow us also to use alternative documents for qualification, like bank statements, profit and loss, and also a new addition, DSCR. Whereas the HELOCs are traditionally full doc only. If you want to go with the alternative doc method, you have to go to the HELoan. So the HELOCs are traditionally used when you want to add on something to a property. You only owe you only pay interest on what you owe, which is the benefit to the HELOC versus the HE loan. The HE loan, you do have to draw the complete loan at closing because it is a fixed rate close and second. It's not a variable rate like the HE loan that does let you draw a certain amount at closing, and then you can continue to draw upon it during the draw period, which is usually for the first 10 years of the HELOC. Uh, so that's the reason why our investors tend to like the HELOCs when they need short-term capital, because they can just draw upon what they need and then pay it off when they're done using the money, and they could have the HELOC available again for when they need any infusion of funds. So let me share with you some examples that I have here at different LTVs so you could compare the rate at the different loan to values. We are able to go up to a 95% LTV on the HELOCs. So definitely adds flexibility when you have a borrower, for example, that wants to refinance and may not want to do a cash out on the first because it is more costly to do a cash out, and also because when you're doing a cash out, it does put LTV limitations on where you could take it. So we like combining those on a rate and term on the first, and then you do the cash out portion on the HELOC. So here we have the HELOC up to a 95% CLTV. The rate on this is 15.125, and there is a 0.5 of an adjustment there also for drawing 50,000. Now we have the HELOC at a 90% CLTV. So you do notice that the rate does drop by 3% because 95 is the limit. 90 is a little bit more standard. So you're looking at 12.125% at a 90% CLTV. So now we have our HELOC at an 80% CLTV. You'll notice again that our rate does drop to 11%. Now keep in mind that the HELOCs can be originated either as a borrower paid comp transaction or a lender paid comp transactions. The example that I have here are all borrower paid comp transactions. So this is our 80% at 11% interest rate. And 70%, you do see that the rate does drop to 10.125. Now, I will state that the floor for these, basically, you're looking at a prime rate of 8.5% rate. So here at this 70% CLTV, we're only looking at an add-on of 1.625 margin to the prime rate of 8.5. So this is a very good option. If you do need the lower rates, you would need to go with a HE loan, like I did mention. However, the big difference that you're going to find between the HE loan and the HELOC is that the HE loan will require you to fund the full amount of the loan at closing. So if your borrower does not need access to the full amount at closing, the HELOC, even though being a higher rate, will be a better option for your borrower. And again, also remember that the HELOCs can be combined when doing a refinance of a first, so that you can do the first as a rate and term and then do the actual cash out portion of the transaction from the HELOC, which would save you also, because you have limits on the cash out, And when it's a cash out transaction, there will be loan level price adjustments that you will not face when it's a rate and term. Usually it's like 1 to 1.25 points, more or less, are the loan level price adjustments when you're going cash out versus rate and term.
All right. I don't see any questions here, but as Nick said, we will continue to do some trainings on, like the fixed seconds and stuff like that. And we've done some in the past as well, too, so you can look those up on our YouTube channel. But remember, we do this show 11 a.m. Eastern every single weekday where we go through some rates. Then we do a deep dive into a different topic. So we will be back here tomorrow with a new topic. We appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. And we'll see you tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Everyone have a great day.
Thanks, everybody.